All right, greetings from San Diego. Let's talk about bonds and long-term notes. All right, first thing is there's several different ways companies can generate enough funds to do their projects, whatever projects they decide to do. First, they could generate them internally. Usually a company cannot generate enough income internally to do very large jobs. So for very large jobs, they're usually having to go to outside resources to finance large projects. And that can be either by issuing more equity, selling stocks, or issuing debt, which is long-term notes and or bonds. As it notes here, these the debt, not the equity, but debt has to be reported as on the balance sheet at its present value, and so that's the present value of the principal and interest payments at the effective rate of interest at issuance. That's hard to say. What is a bond? Well, it's usually a large amount divided into smaller amounts. And so, a company might issue $1 million worth of bonds at $1,000 per bond. And so what does the bond do? Well, it's a promise to pay back the face amount, $1,000 at a specified maturity date, and until maturity date, the company agrees to pay a stated interest amount, usually semi-annually. Now, the bond indenture is just the promise. Sorry, I'm talking kind of funny because I bit my tongue really bad this morning eating breakfast and it kind of hurts. The bond indenture is just the promises made by the corporation to the investors in the bonds. And they don't give this indenture to every bond holder. They just it's held by the trustee, usually the investment company selling the bonds. And if the company defaults, doesn't meet their obligation, then the trustee can sue to force the company to meet their obligations. Most bonds, you have different types of bonds here. Most are what's called debenture bonds, meaning they're unsecured. They're simply secured by the full faith and credit, meaning the promise to pay of the issuing corporation, the strength of their credit standing, if you will. No specific assets are pledged as security. And so an investor has the same standing as general unsecured creditors. Most bonds are callable, meaning that the corporation can pay them earlier than the maturity date. The reason why they would do that is if interest rates in the market fall, then the company would be stuck with a bond that they're paying too high, well, an interest rate that's higher than market. It would make sense for them to call that bond, pay it off, and then go issue new bonds at the lesser rate that's in the market. And so the bond is a liability on the balance sheet of the corporation issuing the bonds. Of course, it would be an asset to the investor who buys the bonds. Again, we have kind of a running example, I believe, here. This company issues $700,000 of 12% bonds on January 1, 2016. So they're paying semi-annually, $42,000 at June 30th and at the end of the year. This bond matures in 3 years at the face amount, meaning the market rate and the stated interest rate are the same. And that's usually true when a bond is initially issued for the first time. What happens is, the first time a bond is issued, the corporation is going to have a stated rate that is similar to what the market rate is. But realize that these interest rates fluctuate, they go up and down, and these bondholders can sell these bonds just like stock in the open market. And so if they want to sell a bond, they have to look and see what the market rate is and compare it with the stated rate to determine how much they can sell it for. And so let's say that the market interest rate is less than the stated rate of their bond. Well, potential investors can either at 10%, they can buy a new bond somewhere else at 10% and get a lower interest, or they could go get this bond at 12%, because this bond pays 12%, they're going to have to pay extra for it. Okay? And so the bottom line is that you're going to pay more than face value when the stated rate is more than the market rate at the time of the sale. And so it's called selling at a premium. Now, if the market rate is more than the stated interest rate, that means that potential investors today could go out in the market and find some other bond that's paying 14%. So why would they want to buy your bond at a stated interest rate of 12%? Well, so if you are holding the bond, and you want to entice someone to buy your bond, you're going to have to sell it for less than the face value in order to make it have returns equal to 14%. And so you see there, they're having to sell it for less than the face value. The percent that is stated on the bond's face is also related to the corporation's bond rating. Don't really want to talk about it too much, but the higher the rating, AAA, the better the bond, the less riskier it is. The corporation with a AAA grade bond rating is less risky and thus doesn't have to pay as much interest on their bonds. So they can issue bonds with less percentage stated interest. Whereas, you get down to a junk bond level, double B, B, or below, in order to attract investors, they've got to pay more interest because it's more risky. So how do you determine the selling price? Well, it's the present value of the principal payable at maturity discounted at the market rate plus the present value of the periodic cash flows of the interest payments at the stated rate. And so the present value of the principal payable at maturity is going to be the present value of $1, and then the other stuff's going to be the present value of annuities. So if you recall, you have those charts in your book, so you should be able to do this by now. Now, these bonds are quoted in the market at a percentage of the face value, okay? And so what that means is if they're quoting a bond at 98, that means it's 98% of whatever the face value is, usually $1,000 per bond. And so that means that the bond is selling at $980. Now, if it sells for more than 100%, then in this case 101, that means it's selling for 1,010. And so anyway, here's an example of how you would calculate the present value. In this case, the market interest rate is 14%, and this bond's interest rate, remember, is 12%. So they're going to have to sell this bond at a discount to entice investors to buy this bond. And to figure out what the present value of this would be is you would figure out the interest payments. And so you look at the present value of an ordinary annuity of $1. Your N is going to equal 6 because there's 6 payments of interest over the 3 years, semi-annually. And each payment is going to be made at 7%, which is 1/2 of the 14% market rate. Okay? Now, as far as the principal is concerned, you look to the present value of one table, or if you want to, I think the book out to the side has the information on how you put this into a financial calculator. Your interest is going to be 7%. N is going to be 6 again, and you're going to multiply that times the full face value of the bond, which is $700,000. And so you come up with 666,633. Okay? Now the next thing we want to talk about, see where we are here. Okay. We're at page 793. So here's your entry journal entry, one for the issuer, the issuing corporation, the other for the investor. So the question is, we have to get the amount owed. Well, we have to take this discount on bonds payable and amortize it, okay? Which means in this case, it's in the debit column, and each time we make an interest payment, we've got to issue a credit in the amount of who knows. So that's the big issue. Now in the book, as we have seen before, we have the effective interest rate, or the effective interest method. And here, that's, again, you can look at it on page 794 and 795, okay? And it's very similar to what we did way back when we looked at non-interest-bearing loans, I believe it was. I think it was pretty much the same example, same amortization. And I promised you that there was an easier way to do this. And so we're going to skip over the effective interest rate, and we want to look at the straight line method. So I'm going to move to the straight line method here. Okay. So anyway, here's our example. Okay, we've got this $33,367 discount that we've got to amortize. And so what we want to do here is the following. It's $33,367. We're paying this over 6 periods, right? Semi-annually for 3 years. And so we just simply divide the discount into the number of periods that we're going to pay interest. Now recall, we're paying $42,000 of cash semi-annually, so you know that amount. That's going to be a credit. You know that we're amortizing using the straight line method. We're going to, remember, discount on bonds payable was initially a debit, right? And so we've got to reduce that discount by crediting it each time semi-annually for $5,561. Okay, so you know you've got 2 credits there, one for $42,000, the other for $5,561. That total is $47,561. Your debit, if you want to call it a plug, because that really is what it is interest expense for $47,561. Okay? Now, what if this was a premium on bonds payable? What would it be? Well, it would be the premium on bonds payable would be a credit balance initially, and you would simply, to reduce the premium on credit balance or bonds payable, you would debit it semi-annually. Okay, so I told you this will be a lot easier You simply take whatever the discounted premium is and divide it into the number of periods over which you're going to pay interest. Whatever that total is the amount you amortize each period. You know what your interest payment's going to be. So if you know those two numbers, you can come up with your interest expense. Okay? Much easier. And look at that. Every time, 5561. So what it does is it increases the outstanding balance so that at the time of that last interest payment, outstanding balance is the same as the face value. And so the reason why they allow you to do the straight line method versus the effective interest method is if it's not going to be a material change between the two, then it's easier to use the straight line method, and most companies use the straight line method simply because it's not material. There's not a material difference between the two. Let's talk about long-term notes. You borrow money. If you've ever done this, I mean, it's like when you borrow for a car. You sign a promissory note saying you're going to make payments. Usually you're going to make installment payments. And if these payments are of equal amount, those payments include a principal portion and an interest portion. And so let's say you get you sign a note for $700,000. You get the cash. This would be your entry if you're the borrower. And you know, in this case, they're paying semi-annually. Again, I think it's 12%. And so semi-annually, they're going to pay $42,000 for 6 periods. And then at maturity, they're going to simply pay the principal amount back. Now that's not paying an even amount of principal and interest. In other words, most installment payments have some portion that's principal, some portion that's interest. Usually at the beginning of the loan up to the middle of the loan, you're paying more interest than principal, and then it flips as you get closer to maturity. Here, this would be like a balloon note where you're simply paying the interest and then paying the principal back at maturity date. I don't know how many of those type of loans there are. I guess if it's 6 months, that's pretty short. I guess if the company has good credit, they might be able to get that. A note exchanged for assets or services. I don't know how often that happens, but if it does, if there's no, I guess if there's no stated interest, you're probably going to have to imply some interest. And so here, they're issuing a 3-year note for $700,000, 12%, to be paid semi-annually. Machine could have been purchased at the cash price of $666,633. That sounds familiar. So look, you have all the makings of the same, basically the same entry that you made before with some minor alterations. And so again, you would debit the machinery for the amount you could purchase it for at cash, 666,633, and then you would have the note payable, of course, for 700,000, and the difference, the 33,367, is going to be listed as a discount on notes payable. So very, very similar to what you saw with bonds. And then again, you could do the straight line method here and simply amortize this using the straight line method on that discount on notes payable. Here is what I was talking about, the installment notes. That's where you pay equal amounts each month, and a portion of that equal amount each month is interest, and part of it is to reduce principal. And normally what financial institutions do is they have built-in amortization tables that will you can print out and see each period how much of your monthly payment is attributable to interest and how much is attributable to principal reduction. And so here we have a loan for 666,633, and we take and look at our table for the present value of an ordinary annuity of $1 if N equals 6 and I equals 7%, and that is 139,857. So every payment, every one of our 6 payments is going to be 139,857. So there you go. All right, let's talk about financial statement disclosures. I think we're almost done. Well, the fair value of the financial instrument must be disclosed either in the body of the financial statement or the disclosure notes. And like it says, disclosure notes should include nature of the company, liabilities, interest rates, maturity dates, call provisions, conversion options, restrictions by creditors, and any assets pledged as collateral. Not a big deal. I'll let you read those on your own. Moving on. Okay, looking at early extinguishment of debt. You want to retire this debt early for whatever reason. And so these balances you want to get removed from the books, and the difference between the book value of the debt and the reacquisition price represents either a gain or a loss. Okay, so again, recall back to what we talked about, bonds being callable, and usually there's a stated amount that they're callable at. Let's say it's 110%. And so again, if it's whatever they pay, the difference between the book value of the debt and what they pay for it to get it back is either the gain or loss. So here we have an example. This Masterware called its 700,000 12% bonds when the book value was 676,288. Remember, these were sold at a discount, and we amortized two periods or one period. And so the book value after some amortization is 676,288. I guess that's 23 and something worth of amortization still left. And if the indenture agreement specified a call price of 685, that means that there's going to be a loss. Well, there's the rest of your unamortized discount down there, $23,712. So, I mean, if you know that you're going to have to pay $685 to get it back, you know that your bonds payable is $700,000, and you know that the remaining unamortized discount is $23,712. And so whatever it takes to balance those is going to be either the loss or gain. And so in this case, it's a loss that balances this entry. Now, sometimes you can have what are called convertible bonds. These are exchanged for shares of stock. Usually, this is something that is desirable to investors, and so these bonds can sell for a higher price. What the hell? Not sure what happened there. Anyway, I'm in a hotel and they just timed me out, I guess, for another, they want me to pay for another 24 hours of internet service, which I'll do as soon as I get through here. Anyway, the reason why you would buy these convertible bonds if you're a potential investor is because you have it really the best of all worlds, in that you could convert these bonds to stock. It's good for the seller of the bond because you can sell these bonds at a higher price because they're more desirable. So here we have an example. On January 1, 2016, HTL Manufacturers issued $100 million of 8% convertible debentures. Those are bonds due 2036 at 103%, meaning 103% of face value. And so it's going to be $103 million. That they're going to receive in cash. The bonds are convertible at the option of the holder with no par common stock at conversion rate of 40 shares per 1,000 bond. Anyway, the bottom line here is because it's convertible, they were able to sell it for a premium over the face value of 100%. And so they're getting 103% of $100 million. They're paying these convertible bonds of $100 million, and so the difference is the premium on the bonds payable. Again, a plug number. To continue with the example, on January 1, 2016, HTL issued 100 million of 8% convertible debentures due 2036 at 103. The bonds are convertible at the option of the holder into no par common stock at a conversion rate of 40 shares per 1,000 bond. HTL recently issued non-convertible 20-year 8% debentures at 98%. So what are they doing here? Well, I guess they're saying that half of the outstanding balance was converted at 51. They don't really say. See if it says in the book. Yeah, it says if the 50,000 convertible bonds were held by a single investor, the company would record the following. Not sure why they didn't do that. Anyway, that's probably not that important. This is not important. This is not important. And I think that's it. Anyway, I'll put an assignment out there for chapter 14 tomorrow.